Have you ever wondered if you're shopping for the right house or if you're about to make a financial mistake that could ruin your wallet and your stress levels? By the end of this video, you'll know exactly how much house you can afford based on your income. And more importantly, how to avoid getting stuck with a mortgage so big, it feels like you accidentally adopted another child. And trust me, most people mess this up. But I'll show you a trick that banks won't tell you, so you can buy smart and still have money left to enjoy life. All right, let's get into it. Buying a home is exciting until you realize how confusing the numbers are. You've got lenders throwing random percentages at you, mortgage calculators giving you different results every time, and real estate agents who seem a little too eager for you to stretch your budget. So, how do you actually figure out the right price range for a home without ending up house poor? That's exactly what we're breaking down today. I'll walk you through the golden rule of home affordability, real-life examples for different income levels, and a few common traps that people fall into. The first major rule to understand is the 2836 rule. This is your home buying cheat code. Financial experts, and by experts, I mean literally every responsible financial advisor ever, say that your monthly mortgage payment should not exceed 28% of your gross monthly income. And your total debt, including credit cards, car loans, and student loans, should not go over 36% of your income. Let's put this into perspective. If you make $50,000 a year, your monthly gross income is about $4,167. That means your max mortgage payment should be around $1,167 per month. But wait, does that mean you can afford a house that costs $1,167? Nope! That's just your monthly payment, and it includes principal, interest, property taxes, and homeowner's insurance, aka PITI. Now, let's take this rule and apply it to actual home prices, because that's what you really want to know. If you make $50,000 a year with a 20% down payment and a 6.5% mortgage rate, you're looking at homes around $200,000 to $225,000. If you make $75,000 a year, your safe home buying range is $300,000 to $350,000. If you earn $100,000 a year, you can likely afford a house in the $400,000 to $500,000 range, $450,000 range. And if your income is $150,000, you're in the $600,000 to $700,000 territory, but only if you're not drowning in other debt. But here's where people go wrong. Just because the bank says, hey, you qualify for a $400,000 loan, doesn't mean you should actually borrow that much. Lenders aren't thinking about your future vacations, retirement savings, or your ability to afford avocado toast. They just want you to take the biggest loan possible because that's how they make money. So even if you follow the 2836 rule and find a house within your range, there are still hidden costs that first-time buyers often forget. First, property taxes can vary wildly depending on where you live. A $300,000 house in Texas might have $7,000 in annual property taxes, while the same priced house in Florida could be closer to $3,000. That difference alone could add $300 plus to your monthly mortgage. Then there's homeowner's insurance. If you live in a hurricane, earthquake, or flood-prone area, expect to pay way more than someone in, say, Nebraska. And don't forget HOA fees, because nothing says surprise expense like an unexpected $400 a month just to have a community pool you never use. Lastly, maintenance costs can be a real budget killer. The general rule is to expect to pay about 1 to 3% of your home's value per year in maintenance. That means if you buy a $400,000 house, you should budget $4,000 to $12,000 per year for things like roof repairs, HVAC replacements, and that one time you accidentally put dish soap in the dishwasher. Now that you know the numbers, let's talk about mindset. Should you buy at the very top of your budget or keep things conservative? The truth is, it depends on your goals. If you're confident in your income growth, have no major debts, and plan to stay in the house for at least 5 to 7 years, it might make sense to go for something at the higher end of your range. Real estate generally appreciates, and locking in a good mortgage rate early can be smart. But if you're in a career that's unpredictable, looking at you, entrepreneurs, and commission-based salespeople, or you like having extra financial breathing room, staying below your max budget is always a good move. Having an extra $500 to $1,000 a month in wiggle room means you can handle unexpected expenses without freaking out. Here's the secret most people don't realize. Banks will often approve you for way more than you should actually borrow. Why? Because they calculate affordability based on your gross income, not your actual take-home pay. After taxes, retirement savings, and, actual life expenses, you have way less money to work with. So always calculate your home buying budget based on your net income, not gross. Another tip, if you're planning to buy soon, test drive your future mortgage. Let's say your rent is $1,200 now, but your estimated mortgage will be $2,000. For the next 6 months, pretend your rent is already $2,000 by saving the extra $800 every month. If you struggle to do that, your mortgage will definitely feel like a chokehold. All right, let's wrap this up. We covered how to calculate how much house you can afford, real-life price ranges based on income, hidden costs that can wreck your budget, and why banks will try to loan you more than you should take. The bottom line, just because you can afford it on paper doesn't mean it's a good idea in real life. Be smart, budget wisely, and don't let a mortgage control your entire life. If you found this video helpful, hit that like button. It seriously helps the channel more than you know. And if you want more no BS financial advice, make sure to subscribe because I've got even bigger videos coming soon. Let me know in the comments, what's your dream home price and does it actually match what you can afford?